If you haven't read the section in your book, the little red book, on applied financial intelligence, it's like 2 chapters and they're short. Make sure you do. It's actually really good. It's kind of honestly like the crux of the whole book, okay? This is where, for a business owner, everything kind of comes together. So if sometimes you don't have the window open, but I'm sharing my screen with you right now, and it has something on there called the cash conversion cycle. You'll see, if you Google cash conversion cycle, you'll see lots of different versions of it, because sometimes some businesses are manufacturers, so they have to go from cash to raw materials, and then turn the raw materials into their finished goods, and then which is their inventory, and then their finished goods they sell. But honestly, the cash conversion cycle is this idea of, we start with an asset, cash, then we convert that cash into inventory. We do that through purchasing, right? If we're a retail store, we go to our supplier and we buy inventory. If we're a manufacturer, then we convert that cash into different types of inventory, like I said, raw materials, and then we apply work to those raw materials and turn them into finished goods inventory that we can sell. Then we turn that inventory into accounts receivable by selling the inventory to somebody. And then finally, we convert the accounts receivable back into cash by collecting that money from the people we sell to. This, I'm sure, seems ridiculously obvious and elementary to you by this stage of the game. Which, again, I think I told you early in the class, if you could look at an income statement and recognize that really the only way to increase your net income is to increase your sales or decrease your expenses, that you are smarter than most business owners I've met. Until they think about it, then of course they knew that. I think this is another one of those issues that's like this, where honestly, every business is only in the business of doing this, taking cash, turning it into inventory, or to a service, right? Some places don't sell inventory, but instead they sell a service. Like if you want, a massage therapist would just use the money they have in cash to go and keep the lights on at their office so people can come in and they can give them massages, right? But the point is, we take our cash, we convert it into something to sell, then we sell it, then we collect on it, and that's business. Like all of the rest of the stuff, every other class you'll take in a business degree is just telling you the various ways to go about doing this, okay? So, and the reason this matters so much is because without cash, a business is dead. A business can't operate without cash. I always tell people I really love my job. I love the students, I love working with them, but if my employer said to me, hey, we're out of cash, we can't pay you, but will you keep working? The answer would probably be no, right? Not because I don't love it, but because I've got bills to pay and people to feed in my family. So when a business runs out of cash, they can't buy more inventory to sell, they can't pay employees to work, they can't pay for the electric bill and the insurance, and so they're out of business. Even nonprofit businesses have to have at least enough cash to cover those costs. So even if you're like, I don't care about money, I only care about saving the whales, or whatever your passion is, you still have to have enough money to buy fuel for your Kodiak boat to drive out there and spray paint on the whalers' vessels or something, like whatever you're doing, you have to have money to do it. All right, so that's why this matters. All right, so mathematically, the cash conversion cycle comes down to this: days sales outstanding plus days in inventory minus days payable outstanding, where days sales outstanding means the amount of time it takes you to collect the money your customers owe you. And days in inventory, DII, is the amount of time it takes to sell your inventory to customers. And days payable outstanding is the amount of time you take to pay your suppliers. So we have cash, we purchase inventory. We have inventory, we sell it to customers. We have accounts receivable, we collect it. The amount of time this takes is dependent on how long it takes us to sell stuff, plus how long it takes us to collect, minus the amount of time we get to take in order to pay. So if you're Home Depot, who's negotiated 90 days to 120 days payment terms, oftentimes they will buy inventory, they'll sell it, they'll collect it, and then they'll pay for it, which is awesome, right? But not everybody gets to do that. So this one little mathematical equation here, our ability and how quickly we can turn cash into more cash, that really determines how successful we're going to be at business. Again, you don't have to be the fastest in the world. You have to be fast enough to cover your bills and make the amount of money you think you need to make. All right. So with that being said, don't you like a presentation that's just 2 slides? I do. That being said, now what I want to do is I want to pull up our homework. Okay. So our homework. Let's see. I'm going to go to financial management. And then I'm going to go to modules. And I'm going to go to the individual assignment for applied financial intelligence. It's in a weird order how I should have it down here. Hey, also, if you guys haven't done the course evaluation, that's worth extra credit. Bumps your grade 1 percentage point up, your whole grade. So get in there and do that. Tell everybody that you love me and you think I'm the best teacher ever. Or if you don't, then you can be honest, I guess. But, you know. Anyway, so we're going to go to the individual assignment, applied financial intelligence. And we're going to click on this applied financial intelligence for Happy Jacks. Okay. And what I want to do is I want to go through this together. So this is a company called Happy Jacks. They sell pirate clothing, and they're concerned about their low cash flow. So he's coming to you for some advice on how to fix his cash flow issues. Let me see who all we have in the group here today. I see Abby, Noah, Chloe, Rosalind, and Kiora. So no Justin, no Sarah. So here's what I would like for you guys to do. I would like for Abby to calculate the days sales outstanding for 2017 and 2018. And when you get that answer, just share it in the chat. Okay? And then Noah, will you do the days in inventory?
Yes.
Okay. And Kiora, will you do the days payable outstanding? Okay. Now, Chloe and Rosalind, you're not off the hook, but in fact, you can work these out yourself, and you're gonna, you know, it might be valuable to do that. But I'm just asking these 3 to work them out and report back to the group, and then I'll be asking some other questions here in a minute. Abby, is that your room at, like, are you at home? Oh, you're still on mute.
It's kind of like an office. So this used to be like my brother's room, but since he's on a mission, now it's like an office
So it
for
happens.
like my dad.
Kids move out and you take over their space and you paint it green. I was just noticing the green with the wood. It's kind of a cool look. I would never be so bold as to do green like that. It's awesome.
It's 'cause- 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 '
Sorry, I didn't mean to pop up my regression analysis on there. That's for everybody who's not in statistics, so they can feel happy about the fact that they're not in statistics. Let's see, Kiara, I'll check what I have. So you were doing the days payable. I got 10.47 on mine, which is just a decimal place off. You see how I got that? Yes, that's what I got, Abby. Good. Yep, that's what I got. So there's our days sales outstanding. Good, Kiora.
Mr. Fox, which I have to do it? This is Rosalind.
Right. So what I said is everybody can be doing this. I just was asking those individuals to report those specific ones. So Abby to do days sales outstanding, Noah to do days in inventory, and then Kiora to do days payable outstanding to report those answers back when they got them for the group. But you know, we're all going to have to do it because it's a homework assignment. So you can definitely be doing it on your own and seeing if your answers match up with everyone else's.
Okay.
Let's
Thank
see,
you.
Noah, yeah, that's the same as I got, 25.23 for days in inventory and 27.71. And then Kiora got 11.56, perfect. So you guys all got the same answers as I got because either you're smart or because we're all dumb together, meaning I messed it up and then I taught you wrong and then you messed it up. But I'm pretty sure I'm right about this. So here's what I got right here. I kind of cheated because I have it all, the balance sheet in here and the income statement in here. So then all I had to do was bring my formulas over. All right. So as we look at this then, we're saying in 2017, it took them 8.82 days to collect on their sales. That's pretty good. This is actually pretty normal for retailers because a lot of times most of their sales are in cash, right? So they're collecting most things right when they sell it, and only a small portion of their sales are on credit. And then we see in 2018 that increased. So it took them longer to collect in 2018 than what it took them in 2017. Their days in inventory in 2017 were 25.23. And then they were 27.71 in 2018. So it took them about 2 days longer on average to sell their inventory in 2018 than it took them in 2017. And then their days payable outstanding, they were paying within 11.56 days in 2017, and now it's taking now they're paying within 10.4 days. So that's very close. And so if you remember, the formula is our days sales outstanding plus our days in inventory minus our days payable outstanding is how long it takes them to convert their cash, into more cash. And so we can see that it took them 22.5 days on average in 2017 and 29.5 days in 2018. All right. I'll say what formula again, Kiora? Cash conversion formula. Yeah, so let me just bring back up the so here's the slide for the cash conversion cycle. So it's days sales outstanding plus days in inventory minus days payable outstanding. Or in other words, how long it takes you to sell or to collect the money that's owed to you, plus how long it takes you to sell the stuff from inventory, minus the amount of time you have to pay for it. Okay, so let's go back to our, where was that at? I think it was here. All right. So we successfully completed the first part, days sales outstanding, days in inventory, days payable, and then the cash conversion cycle we completed. That was on my Excel spreadsheet. I think I explained in my own words what the changes in each measure mean. Anybody have any questions about that? Like what it means that it took them longer to collect on the money owed to them. And that's typically a negative thing, right? Taking longer to collect. Take them longer to sell, also typically a negative thing to take longer to sell. So lower is better with those two measures. And then they're paying their suppliers a little faster. That's neither negative nor positive. What I always say is take as long as you can within reason. So if the supplier will give you 30 days, then pay them. Take 30 days to pay them. That lets you free up cash. Of course, if they're offering you a discount to pay early, maybe it's worth it. Then you pay early, right? So anyway. And so overall, it's taking them longer, about 7 days, right? So not about 7 days, exactly 7 days. That's an extra week, okay? So depending on the size of a company, I want you to consider this. If we look at, so Happy Jack's income statement, so they're a pretty good sized company, right? They're doing over $1 million. Oops, those are weird numbers on there. That should be 16, 17, 18. I'll just get rid of those. They're confusing. Anyway, so they're doing $1.2 to $1.4 million a year in sales. Okay, so consider what that is weekly, right? If I say, I'll just take this middle year, 1,320,000. I'll divide that by 52 weeks in a year. They're doing $25,000 approximately in sales every week. And so if their cash conversion cycle has slowed down by 7 days over the course of a year, that means they're going to have $25,000 less in their cash account on average. Now they may have more at one, when you look at a balance sheet, it's just showing you that measure at that moment in time. So, right. So, but on average, they're going to be $25,000 behind, so to speak, on converting cash. And that's a lot of money. right? That's maybe not to you guys, but it is to me. 25 grand is a fair amount. We might look at their balance sheet and see, look at their cash situation. At the end of 2 years ago, they had 98,000. Now they have 44,000. Now they're barely getting by. Just so you know, in real life, when businesses come to you, it's usually when it's something like this. It's not like here where they're like, oh, I've still got 40,000, I'm good. It's like here when it's like, I don't have enough to pay my employees, what do I do? And you're like, well, you probably should have fixed this a year ago, right? All right. So, you know, sometimes it helps to break it down into like what that actually means. 7 days doesn't sound like a big change, but when you're doing $25,000 in sales a week and you're slower on collecting that, then that's definitely an issue. All right. All right, so what do you guys think Jack's biggest problem is? Maybe everybody in the chat put what you think. What do you think? So looking at the numbers that we just generated ourselves, looking at the statements, where was it? What do you think the biggest issue is? Chloe and who else hasn't answered here? Rosalind, what do you think are what do you think, just share that in the chat. What do you think are the biggest issue that this company is facing?
Oh.
Do you know how to find the chat?
I am with my iPhone and like it's not working like I should, but I don't know.
Okay, well, and I don't have it on my iPhone right now, so I'm not sure. The best way to tell you to find it. Let's see. Anyway, so it's okay. So I've seen a couple of answers about just collection, that they're running out of cash is what Chloe said, which is, I mean, that's the question is that the symptom or is that the cause, right? They're not actually losing money. If you look at their income statement, their net income is about the same every year, right? So that's interesting because they're losing money in the sense like they have less cash, but their sales are actually improving and their net income is about the same. And so Abby pointed out that the accounts payable went up, and inventory went up. Let's see, balance sheet. What was that?
Accounts receivable.
Accounts receivable, yeah. So now we're starting to kind of hone in on what's causing this problem. And that's kind of what Kiora said in collections, right? 3 years ago, they were owed $28,000. This year, they're owed $49,000. So that is $20,000, $21,000 that they have not collected over the last 2 years. And then the other thing is that their inventory has gone up dramatically. So from about 49,000 to about 75,000. So that's $35,000. So between those two things, what did we say, about 30,000 here and about 20,000 there? There's 50,000 of the difference in cash. And then we might look at and see they've actually, yeah, it's hard to explain what the rest of that is. Maybe their liabilities. So the bottom line is this: they're not collecting money, and they're keeping probably too much inventory. I don't know that it's too much because I can't tell what the right amount is. Maybe they were keeping too little before. And maybe by having this higher amount of inventory, they're actually able to have a higher amount of sales. The thing with keeping inventory is you don't want to have too little, because then you run out of inventory. And customers get very upset if you run out of inventory, and they start going to your competitors. But you don't want to have too much, because then you have, instead of having cash that's available to you, you have inventory sitting there on a shelf. So you want to have just the right amount of inventory. Otherwise, it ties up all your cash. So thank you. Your observations are really good observations. When you look at these and try to make these observations, what you should be asking yourself is, there's a symptom here. That is that I'm out of cash. I have low cash. What's the cause of that? And the biggest causes here are their increase in receivables, their inability to collect money, and that they've increased their inventory. And then you can start to look more deeply into those and say, which of those is something we can do something about. Maybe we can't do something about inventory. Usually we can do something about receivables. At least going forward, we can maybe stop extending credit to people who don't pay, right? All right. All right. So let's provide Jack with at least 5 suggestions on how to improve his cash flow situation. So again, share those to the chat, and we'll see what we come up with. You don't have to share 5. How about everybody shares 1, and we'll see if we come up with 5 good ones between everybody. Hey, Sarah got here. Hi, Sarah.
I don't know what that means.
Oh, Siri's telling me it doesn't know what I'm saying because it thinks when I say Sarah, I'm saying Siri. Abby, what do you mean by manage company inventory?
Evaluate if they're keeping too much or the right amount, and basically just evaluate if it is helpful to keep that surplus of inventory.
Perfect. Yeah, there's actually consultants who do just that, who just do inventory management, because it's such a big deal in deciding whether or not a company survives, honestly. So good one. That's one. What else could we recommend to them? Okay, good, Kiora. Yeah, at the very least, we could say, let's take a look at your supplier relationships and understand what their payment terms are, right? Like if they're cool with you paying them in 30 days, that could free up some cash. Again, it doesn't free it up permanently. What it does is, I'll give you an example. Like I usually pay extra on my bills at home. And then I have bills that are like, you don't have to pay us until next year because you paid extra. And sometimes around Christmas time, if I'm buying presents for the kids, I skip a payment, as long as that's allowed by the supplier. So yeah, that's great. We can slow that down, and that frees up cash when we need it, especially like right now, they need it, right? They've only got $1,200 in cash. What else could they do? So yes, that's the Sarah way. She's gentle, so she's going to send out reminders and say, "Hey, excuse me, maybe you should pay me." And believe it or not, that works really well. And then, of course, we could do more aggressive collection tactics too, right? Like, you know, sending out nasty grams, or you know, calling people and saying, "Hey, I need you to pay me." You can, you know, there's a whole range of things you can do, but to step up your collection efforts. Another thing we could do is we could have a sale. Yes, you can hire people to be mean, or you can even sell your accounts receivable to collection companies to get immediate cash. So like, let's say what's owed to them, $49,000. Let's say that they determine that 20,000 of it's pretty old and they're going to have a hard time collecting it. They can go to a collection company and sell that debt to them and say, "Hey, I'll sell this to you for, you know, I'll sell you this $20,000 of old debt for $8,000." And the collection company will pay $8,000 in cash. And then you write off the rest of the accounts receivable, and then the collection company goes after it, and they make money by buying your accounts receivable for, say, $8,000 and seeing how much of it they can actually collect. So yeah, there's all sorts of strategies for that. Another thing you can do is you can offer people, like sometimes when we would get in a low cash flow situation and people owed me money, which is always in the storage business, I could call them and offer them like a deal. Say, "Hey, you owe me $800, and I know I'm probably not going to collect this without auctioning your stuff off. If you can pay me half of it, if you can pay me $400, I will erase your whole debt for only half of what you owe me," or whatever. So you can, and then with inventory, you can clear out excess inventory by having a sale, right? By marking it down, and you won't get as much out of it as you could, but you can get some cash out of it. All right, any other ideas? Chloe or Noah, or Rosalind, anyone else wanna?
I send you by your phone, but I think
Oh, did you
should
text?
be, yeah.
Oh, I got it. Okay, thank you. So Rosalind says send invoices on time. This is actually a really great piece of advice, because a lot of times when you work with businesses that are struggling to collect, you'll find out they have not been doing their billing well. So you know, what happens is you get busy trying to run your business, and billing is like an extra thing. And honestly, you can pay, like if you get QuickBooks, you can pay a little bit, a small amount, a couple, you know, $5 a month, and set it up so that invoices automatically email out to customers every month. You can just set the date and have it automatically do it. And so a lot of times, like if you come in as an advisor, or if you come in as a bookkeeper for a business, and you can set them up on an automatic billing system, which is really quite cheap, it really improves their cash flow, and they think you're a genius, and all you really did was set them up with a product that was already out there. So that's a great one, Rosalind. And a similar one would be to maybe, instead of offering people credit, start accepting credit card payment. And so that way, what happens when you accept a credit card payment, instead of giving people like credit, then what they do is it costs you a couple percentage points, so maybe 2%, but then the credit card company is responsible for collecting that, and you get 98% of the money within 48 hours of the transaction. And then the other thing you can do is you can really analyze who the people are that are most likely to not pay you, and you can stop extending credit to those types of customers, right? And just say we only give credit to customers, or even hire a service to give you credit reports, credit worthiness, and only extend credit to people who are much more likely to pay. All right, so I think there was way more than 5 in that. But I hope you get the idea